Most investors think they need to choose income or growth, but that mindset might be exactly what's holding your portfolio back. Because the real advantage isn't picking one, it's understanding how combining both can completely change your outcome. Today, we're not just comparing funds, we're looking at how building a balanced strategy can impact your wealth over time. We'll break down Schwab US Dividend Equity ETF SCHD, focused on consistent income and quality dividend companies. Then, Schwab US Large Cap Growth ETF SCHG, built for long term capital appreciation. But here's where it gets interesting. When you combine them, you're not just splitting the difference, you're layering income and growth, stability and upside, and most importantly, diversification. Because when one side struggles, the other can offset it. Growth can drive your portfolio higher in strong markets. Income can provide cash flow and help cushion volatility. So instead of relying on a single strategy, you're building something more resilient, and we're going to test that. Same starting capital, same time period, because the goal isn't just higher yield, and it's not just higher growth. It's building a portfolio that can grow, pay you, and hold up when things get tough. Let's open up the spreadsheet. Welcome back to Simply Money. So this is where the idea of either or starts to break down and the numbers tell a different story. We're going to be looking at the spreadsheet. Now what I have here today is I have my Simply Money Portfolio Planner. If you like this, you can get a copy of this down below in the description at Buy Me a Coffee. All of our spreadsheets are available there. This is a very dynamic spreadsheet, and you can do a lot of different things on planning and kind of forecasting out different portfolios and different scenarios. But what I'm using it for today is we're going to do a simple comparison of SCHD, SCHG, and then a combination. What I've done on this spreadsheet is I've put both of the tickers in. And for those that are curious, you can set up different portfolios and you can pick out the tickers. I have a drop down here with a bunch of tickers. And if there's a ticker that's not in there that you'd like, all you have to do is email me and I'll add that. I'm just unable to put every ticker in there because there's so many. As people purchase them, I add what they request. Your portfolio can be in there, and you can put up to 10 different tickers in there. But we're only doing SCHD and SCHG today. In the conservative model, I've put SCHD as 100%. So when we look at the conservative model, it'll be looking at if we invested, as we have right here, $100,000 just in SCHD. Then in the moderate, I put 100% in SCHG. And again, the $100,000 will be invested solely in that. And then in the aggressive, I put 50-50. Now, obviously, the conservative, moderate, aggressive isn't aligned here. I'm just using the portfolio planner because it's nice and I can compare all three of these scenarios side by side. If I was actually going to set this up, I'd put conservative as SCHD, moderate as a combination, and aggressive as just SCHG. But I'm not doing that. This isn't whether it's conservative or aggressive. This is simply to have them align next to each other and compare them. Let's look at conservative first. With SCHD, if we invested $100,000, we're just going to come over here to the forecast tab down here, and we're going to look at 20 years. I set it up on the portfolio engine back here. Sorry, I should have shown you that. At 20 years accumulation, and you can go up to 40 years if you want, but we're just doing 20 years. And on the forecast, that is what we have right here. It shows the $100,000 starting balance. We're not adding anything to it. We're just putting this money in, and then we're going to let it ride for 20 years. This is just to be able to compare it. We could actually go over and we could add $100 a month or $500 a month, whatever we want to do. We could start it at $1,000 and build it over 30 years. You can do that on this as well. But we're just doing one set $100,000 investment and for 20 years to see how they compare. You can see year one, month one, you have the $100,000. It would generate $287 in the month. Now, again, this pays quarterly, so you'd have to adjust that. It would only pay out quarterly, but it averages out what it would be per month. Now, coming down, you can see the end of the portfolio after 1 year, you're at $115,000. you've collected about $3,700 for the year. As we scan down here, we'll go to year 20 on this one real quick, just so you get an idea of what's happening. On the end of year 20, we have our portfolio balance at $2.1 million. So $100,000 invested for 20 years and just letting it ride based on prior data. Obviously, we don't know what the future will hold, but based on prior performance, that's where your ending balance would be. You can see that your year income is now up to $68,000 per year. SCHD is a good way to build a portfolio. It has some growth in it, and it builds its dividend because the dividend not only pays, it grows the dividend. So it's a nice way to build a portfolio that has a lot of downside protection while building up some income. Remember that $2.1 million after 20 years, not too bad. Now, as you remember over here in this column, the moderate, we put 100% in SCHG. We're going to go back to the forecast. We're going to change this to moderate, and it switches it. Now this is SCHG's portfolio. You can see the yield is basically nothing. You're getting about $31 a month. You can see right here at the end of the first year, you would have got about $400 in income. This isn't an income play. This is purely growth. And you're going to see the income difference. Let's just jump back real quick here to conservative. See $115,000 for SCHD. And for SCHG, $115,000, a few $100 more in 1 year. And that's where people get confused, and a lot of people lose track of what investing is all about and don't have a long-term vision. Investing is long-term. And if you're comparing something like SCHD and SCHG, the growth factor is not going to be very different on a lot of funds in 1 year. One fund may have a bad year or a couple bad years. Long term, you have to see which one has the growth or the income you're looking for, or as we'll see, maybe a combination of both. As we come down here to the end of year 20, right here, you can see that now our portfolio is $2.4 million. Don't want to act like this isn't a lot, but $300,000 more for a pure growth fund isn't extremely different from the 2.1 that you had with SCHD, which is really considered an income dividend ETF. You can see the power of the growth and the dividend snowball with SCHD. With SCHG at the end, remember we had 68,000, I believe it was, maybe it was 64,000 with SCHD at the end of 20 years. Now with income for SCHG, you're only looking at 8,000 a year. You would definitely have to sell shares to generate income if you had solely SCHG. Where with SCHD, and we'll go back over here real quick, it was $68,000 per year. You may not have to sell if you had solely SCHD in this scenario. Again, I don't recommend going all in anything. I think diversification is important. This is a good place to stop and point out this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know all investments come with risk, including the possibility of losing your capital. As you see those two, there's not a huge difference at the end of 20 years. Obviously, I'd rather have 300,000 more if I was solely in SCHG. Now we're going to go back over here. Remember, on the aggressive model, we just have a 50-50 where we put 50,000 in SCHD, 50,000 in SCHG. We're going to come over here and we're going to switch this model to aggressive. And I want you to see right here, starting out at the end of the first year, again, you're right in the $115,000, pretty much right in the middle of the two. And you're getting about $2,000 of income. Now let's go down to our year 20 and see what we have here. The end of year 20, now we're looking at we have $40,000 of income. So you don't have the 68 with SCHD, but you don't have the 8 with SCHG. So you have a nice income still, very healthy income. And you're at 2.2, almost $2.3 million. You get a good combination of growth, dividend growth, and income with this combination. These are two of my favorite funds, two of my most held funds in my positions. in my income portfolio. SCHD is the engine there for my income portion. And in my growth section of my portfolio, SCHG is the engine behind that. I like the combination of both of these. Doesn't have to be these two funds, but I like showing these two funds some positives. The expense is pretty minimal. You're not going to find too many funds with lower expense ratios, and there's some really good upside. I want to come over here to the Forecast Pro tab because this one breaks it down per fund, and we can see over here as your income is generating per month, and we're obviously reinvesting it during this accumulation phase. You can see that per month you're only getting 150, then goes up to 200. You can see it growing. And here we have our portfolio total. But I like this tab because over here you can see each individual fund and how it's growing. I want to come down to year 20. Again, we put 50,000 in each one. You can see right here, let's go up here to the last month of year 20. You can see that SCHG pulled the bigger portion, almost double the growth of SCHD, 800,000 versus 1.5 million for your combined. So SCHG did the bulk of the growth for you. But over here you have your income of $2,700 per month, and the bulk of that's coming from SCHD. So remember, with SCHG, you get $8,000 per year if you go solely SCHG. With SCHD, you get $68,000, but with the combination, you get about $40,000. SCHD is still growing, but providing you that income and that income growth, where SCHG is giving you that income boost that you need to continue to build your portfolio. It's a nice comparison to see those side by side like that. We can go over here. We could say, okay, let's do a little more aggressive. Let's go 25% SCHD, and let's go 75% SCHD. Again, this is just ways you can play with this and see how it would compare. And we could come down here and see, okay, so now your portfolio balance is still about the same, $2.3 million. Come over here to the forecast, you can see you've lost quite a bit of the income because you've gained some of that growth. So, now you're only getting about 350,000 with SCHD because it makes up a quarter, and 2 million from SCHG. Again, you can play with this any which way you want. Those are just some comparisons there. Another reason that these are important, I want to show you this chart right here, these two charts. Right here, this is SCHD's annual return. Now, I want you to look at a couple things and see what jumps out at you. If you look at SCHD, you look at SCHG. Obviously, SCHG has much bigger returns, and that's the higher risk. But you have right here, 2022, when the market is down and the market takes a hit, 31%, almost 32% down, where SCHD was only down 3.25%. And this is that hedge that it can protect you with and provide a little bit of stability in volatile markets. Now, it has had times, like look back in 2013, 33% return. Here in 2017, 21%, 2019, 27%, 2021, almost 30%. There are years with big returns, but on average, it holds a much more steady, less volatile beta compared to SCHG. And this is just 1 year. We have had, since 2012, we've had a really big bull market run. 2022 is really the only down year throughout this whole time frame. If you were to go into a 2008, 2009 housing market crash or a dot-com bubble like in the early 2000s, you would see multiple years of these big red losses in SCHG. And that's where SCHD can really provide a hedge for you during those volatile times. So not only are you getting the upside with SCHG, and you're getting the income growth with SCHD, you're also getting a hedge. So they make a nice pairing, in my opinion. What are your thoughts? Do you like both of these funds? Do you like either one of them? Neither? What are you doing with these funds? Are you investing in growth and income? Leave a comment down below. Share with us. If you'd like to see some more comparisons side by side like this, Throw those in the comments. What funds do you want to see in a portfolio? I'm not going to be able to do everybody's different combinations, so I'll take the combinations that are most prevalent. And if you like different pairings, you want to see, let's pair this and that, or maybe 3 funds, throw those in the comments. Your comments help drive these videos and what we do. I appreciate all of that. I appreciate you joining me, and we'll see you next time on Simply Money.